If you're looking to invest in the S&P 500, you're in for a smaller profit margin after Q4. Earnings per share came in at about $54 last quarter. Now, that's just under a 1% change year over year, and you can see on the chart that the high profit growth coming in after the first year of the pandemic, well, that's impressive. And for more on this and the markets, we turn to Rebecca Walser, president of Walser Wealth Management. Rebecca, taking a look at the performance of these S&P 500 companies, have these companies been able to perform well because they've been able to raise prices? I mean, what is behind this and how long can this last?
Well, I mean, I think that the market is really, instead of trying to not fight the Fed, I think the market is trying to push the Fed, right? And so even if we, like the beginning of from October and the recovery that we had last month until now, present day, exempting out obviously these week's numbers and last week's numbers, I think that the market has really expected the Fed to pause or even pivot. We thought maybe Q3, then Q4. Now it looks like maybe not at all. And the Fed minutes obviously indicate that as well, that we expect more than 2 more rate hikes in March and May that were already baked in, and it's going to continue. So I think the market is finally maybe just now in the last 10 days saying, oh, the Fed is actually serious, and maybe we're not going to get the return to sort of 2008, 2009, stimulus, liquidity, low cost of capital. All of those things are not happening. We certainly are also out of, the federal stimulus from the fiscal side. So no more coronavirus payments, no more, additional help for businesses. Those things have all ended. So you're looking at a drying up of liquidity, and the market finally saying, oh, maybe this is actually for real and we're going to have a pullback. And I think that that's made it very choppy and not really have a sense of itself.
And talking about that stimulus and all that help for businesses and for consumers as well, Walmart this week in their earnings report, they talked about the consumer spending, and consumers are really spending on necessities, and they've also been able to bring in the higher income consumer. That's those are the households that make more than $100,000 a year. So the CFO talking about still that there's pressure on the consumer. Do you think that this tells us a story that's a little bit different than what we've been getting as far as the data points that we've been getting about the jobs market and the retail sales, for example?
Yeah, I think it's very alarming. I'm not someone who usually questions the official data from the Bureau of Labor Statistics or any of those things, but I do think that, what happened in January with that 517,000 surprise to the upside is that we had a less than normal seasonal adjustment. Instead of the 3 million seasonal adjustment we usually get in January, it was only 2.5 million, and therefore we were left with a positive swing to the upside, which was surprising. But when you drill down into the data, you can see that, and it doesn't give us the headline positivity that we expected, which is why we still see so many recessionary indicators happening. As far as retail, it's much the same. The number might look at a top line really well, but for example, Walmart is not normally targeting that 100,000 and up consumer. That group is usually not the Walmart shopper. Everyone goes to Walmart, but I'm just saying in general, that's not usually their target demographic that they're going after. What that shows you is that you even have your top income earners going down to Walmart to deal with the price pressures that they're experiencing. And even though we have a top line number on inflation of 6.4, when you drill down and you look the year over year food increase averages, you're looking at over 11% for grocery store food, and you're looking at 17% for restaurants. So I just think that the retail sales number rebounding this past month, 3%, is just not reality, or it's a lagging indicator as opposed to what's really actually happening now, where people are realizing that the funds are drying up. And if you look at credit card debt as a percentage of versus savings, we're in a top upside down situation there. People are almost out of the ability to even charge anything on their credit cards, which would also have further indications of problems for retail. And really where you're looking at the things that are still positive is more on the higher income and the personal consumption expenditures, where they're looking for experiences and they still actually have some room in their budget to have those experiences, helping those retail sales.
All right. Rebecca Walser of Walser Wealth Management, thank you so much. We appreciate the time this afternoon, and great to see you.